This is the Washington State Housing Report for December 2024. Median home prices continued their upward trend year over year, increasing in 17 of the 26 counties within the Northwest Multiple Listing Service. Among the 10 most populous counties, only Thurston and Whatcom counties experienced slight year-over-year declines in median home prices, each dipping by less than 1%. King County, the state's most populous county and home to Seattle, demonstrated consistent growth, with median prices rising in 16 of the past 17 months. The last year-over-year decline in King County occurred in October of 2023, with a modest drop of 2.22%. This data underscores the ongoing resilience of the housing market across much of the state as we close out the year. A strategic warning for homebuyers. For some time, we have cautioned buyers that waiting for interest rates to decline while median prices continue to rise is a risky and often costly strategy. Despite this, certain self-styled housing experts on social media persist in predicting a looming housing bubble or market collapse. While their sensationalism generates significant income for them, it often leaves their followers facing the financial consequences of misguided advice. We encourage prospective buyers to review the historical statements of these commentators. Assess whether their predictions have consistently aligned with the market realities. If their track record resembles a stopped clock, it might be time to seek more reliable sources of information. Additionally, well-meaning advice from family, friends, or coworkers may conflict with professional insights. Unfortunately, this has led some buyers to lose ground in areas they once aspired to live. Compounding this challenge, while the Federal Reserve has lowered the federal funds rate, mortgage rates remain persistently high, further impacting affordability. For those navigating the current market, informed decision-making based on accurate, long-term insights is essential to achieving your home ownership goals. Beware the self-appointed social media housing influencers. November housing data highlights. Supply concerns. The recently released November statistics from NWMLS highlight an increasingly challenging market for prospective buyers. The new listings index for King County single-family residential homes reached its lowest level since at least 2001, as far back as we've tracked this metric to date. It is important to note that while this data reflects the overall performance of King County, the 29 individual map areas within the county can show significant variation, with some outperforming or underperforming the countywide average. We have this data available for active clientele. From a supply and demand perspective, a dwindling inventory of homes typically leads to upward pressure on prices. If this trend persists into early 2025, it may contribute to rising rental costs as housing scarcity intensifies competition across the market. Buyers and renters alike should closely monitor this dynamic as we move into the new year. Federal Reserve rate outlook and its impact on mortgage rates. According to the CME Group's FedWatch tool, there is a 73.8% probability of another quarter-point federal funds rate cut at the Federal Reserve's December 18, 2024 meeting. Projections for 2025 indicate the first quarter-point cut may occur between March and June, with a second likely between July and the end of the year. Beyond these cuts, no additional changes are currently anticipated for 2025, a significant shift from expectations earlier this year. This evolving outlook highlights the need for regular updates as economic conditions and policy responses can change quickly based on new developments. However, an important question arises. Will 2 quarter-point rate cuts in 2025 significantly impact mortgage rates? So far, the 2 rate cuts in 2024, a half point in September and a quarter point in November, have had limited effects on mortgage rates. The 10-year Treasury yield, a key benchmark for home loan rates, has finally started to trend upward on a daily basis, after plummeting immediately following the first rate cut in September. Why the 10-year Treasury yield affects mortgage rates. The 10-year Treasury yield serves as a critical indicator for mortgage rates because its movements reflect investor sentiment about long-term economic growth, inflation, and risks. Mortgage-backed securities, MBSs, the primary financial instruments funding home loans, are priced similarly to the 10-year Treasury. When investors buy treasuries, prices increase, yields decrease, and mortgage rates often follow suit. Conversely, when Treasury yields rise due to selling pressure, mortgage rates tend to climb as well. This close relationship exists because both instruments share a similar risk profile and attract the same pool of investors seeking safe, long-term returns. While recent rate cuts have yet to significantly lower mortgage rates, continued adjustments in monetary policy combined with movements in the 10-year Treasury yield could eventually provide relief for borrowers. Keeping an eye on these trends will be critical for understanding future market conditions. As of December 2024, projections for mortgage rates by the end of 2025 vary among industry experts. The Mortgage Bankers Association, the MBA, anticipates 30-year fixed-rate mortgages to range between 6.4 and 6.6% throughout 2025, with a stabilization around 6.3 in 2026. Fannie Mae forecasts the average 30-year fixed mortgage rate to be approximately 6.2% by the fourth quarter of 2025. Realtor.com's 2025 housing forecast suggests mortgage rates will average 6.3% during the year, ending at 6.2%. Housing Wire expects the 30-year fixed-rate mortgage to fluctuate between 5.75 and 7.25% throughout 2025. These forecasts reflect current economic conditions and are subject to change based on factors such as the Federal Reserve policies, inflation trends, and overall economic performance. Prospective homebuyers and industry professionals should monitor these variables closely as they can significantly influence mortgage rate trajectories. A note to sellers. Sellers should exercise caution despite the points outlined above. While November 2024's total active listings rank as the fifth lowest for any November since 2001, they differ significantly from the index of new listings entering the market. This distinction is important for sellers to recognize. Although the historically low number of new listings this November may raise concerns for buyers, particularly if the trend persists, sellers should remain mindful of two key factors. First, interest rates are unlikely to drop significantly in 2025 unless drastic economic changes occur. Second, and more importantly, the pool of active buyers appears to be shrinking in response to a steady rising median price environment. This is reflective in the widening gap between new listings and active listings. Sellers, be prepared for the March surge. Sellers should also start preparing for the anticipated spring surge in market activity. Demand typically begins to intensify in March, with peak activity occurring between May and July. Historically, June has consistently marked the high point for median prices since 2001. However, depending on economic conditions, median prices have occasionally peaked as early as March or as late as September, though these instances are generally outliers. No one can predict the future with absolute certainty. The best approach is to analyze historical data for insights into potential future trends. This methodology is used by top hedge fund managers and stock market experts who seek to navigate market complexities. However, even with informed strategies, uncertainty remains, a concept comparable to card counting in blackjack. For instance, even when the deck appears favorable, outcomes are not guaranteed and unexpected results can occur. The recent presidential election introduces additional variables. While the incoming president is not unfamiliar, having previously served, this term is his last, which may prompt a push for more aggressive policy implementation than during a re-election campaign. Moreover, the economic landscape has shifted since his first term. The Federal Reserve, which previously focused on raising interest rates, is now in a rate-cutting cycle. Whether this trend persists remains to be seen. We will continue to track and analyze economic and market data monthly as we have for the past 7 years. Each dataset and new insight contributes to refining our models and algorithms, enabling us to better serve our clients and help them maximize savings and opportunities. Finally, it is important to understand that the examples provided are broad generalizations and should not be interpreted as specific investment advice. Any decision should be made in consultation with qualified professionals who are well versed in these methods. The data we use is for illustration purposes and derived from county-level statistics. However, it is crucial to note that King County alone encompasses 29 individual map areas, excluding Belltown, and our examples are based solely on single-family residential property statistics. Other property types, as well as individual map areas, often behave differently from the trends and data presented here. Please comment, like, and share as we distill decades of experience in an industry that creates more millionaires than any other. Thanks for watching. We always appreciate your time.